Hey man, I'm Jusko from ProbMoney.com. In this video, we are going to look at the best CD rates on the market here in 2025. Interest rates have come down a little bit from where they were a year ago, but you can still lock in a 4% or more interest rate. We are going to look at the best CD rates for different terms from 6 months up to 5 years. And then after that, we will do a little more of a discussion about CDs and how they work if you don't know. All right, so let's start with those CDs that have the shorter term commitment. When we look at CDs with a 6-month term, leading the way as I make this video is Community-Wide Credit Union with a 4.65% APY. We've got Bread Financial at 4.5%, and then Basque Bank and Popular Direct at 4.45%. When we look at the 12-month or 1-year CDs, Community-Wide Credit Union again on top with a 4.45% APY, Live Oak Bank 4.4%, Popular Direct 4.3%, and then we've got a few there at 4.25%, including E-Trade, which is Morgan Stanley and Marcus from Goldman Sachs. When we look at the 24-month CDs, which of course is 2 years, on top this time is Popular Direct with the 4.1% APY. A lot of the same names in this list that we have already talked about, although we do also have Sky One Credit Union at 4% and First Internet Bank there at 3.93%. When we look at a 36-month term, which is of course 3 years, same names for the most part with Popular Direct being 4.1% at the top. And then you can see the others there. The only kind of new name in there is Synchrony Bank coming in at 4% for that 3-year term. And then when we look at 5-year CDs, this time Synchrony Bank comes out on top with the 4.15% APY, Popular Direct 4.1, Sky One at 4. You'll see that BMO Alto, which in the past has come in a little bit higher, shows up here for the first time at 3.8%. Now looking at those numbers, one thing I want to mention is that you can see that the interest rates you can get are actually higher on the shorter term CDs, those 6-month and 12-month CDs, better rates than the longer term CDs. And that's because the banks don't know exactly which way interest rates are going, and they're not willing to commit to as high of an interest rate for those 3-year and 5-year CDs. So you can get the higher interest rates on the short term, but of course then the CD is going to come to term, and at the end of it, you're not sure where interest rates are going to be. So you can choose to go for the 6-month or 12-month and get that higher interest rate. But even though the rates are a little bit lower on those lower CDs, if you are willing to commit, you could lock yourself in still at 4% and know you're going to get that 4%, where if you come back a year from now, it's possible that those longer term CDs are going to have even lower interest rates. Now, for the most part, when you look at who is giving the best rates, you are not seeing the banks that you necessarily know. A lot of the big banks out there really not very generous when it comes to their CD rates. And so that's why it makes sense to shop around and to watch videos like this one. Now, if you look at Capital One and Discover, they're not too far below these best rates that we see here, where some of the other big banks are not even in the ballpark. So if you want to go with a name that you know and maybe you trust more, those are a couple places that you could look as well. And while I'm telling you that those are the highest rates on the market as I'm making this video, another place where it's possible you could get even higher rates is through what are called brokered CDs. And these are CDs that you can buy through brokerages. Schwab and Fidelity in particular are a couple places that you might look. And basically what happens is you could get higher interest rates, and you can only get them through the brokerages because it's sort of like, it's almost like a volume discount where they can get CDs from various banks and then they can offer them sometimes at higher rates than you would see even if you went to that bank directly. So it's sort of a strange thing, and there's a little bit of nuance to brokered CDs that I'm not going to go into too much here, but it is possible that you can get better rates, and they're not riskier really or anything like that, but they are something where you have to go through the brokerages and you can check to see if the rates are better. Sometimes they are, sometimes they're not. Now, those CDs I just mentioned that have the best rates for the most part do not have a minimum deposit, so you can put in any amount and get that interest rate on your money. Some of them are going to have a $500 minimum. Some of them are going to have a $1,000 minimum. Some might have minimums a little bit higher than that, but for the most part, pretty low minimums regardless, and in some cases, no minimum at all. Now, as promised, if you are not totally familiar with how CDs work, I will tell you a little bit more. So the idea behind a CD or certificate of deposit is that you are committing to have your money deposited for a certain amount of time in order to get a higher interest rate than you would probably be able to get through a regular bank account. So you are committing to some term. Like I said, 6 months, 12 months, 24 months, 36 months, 60 months are the ones that I just looked at, although there are other terms potentially for CDs as well. So you give the bank a certain amount of money, they are going to lock in that interest rate, so you're guaranteed to get that much in interest when you get your money back. However, you do not get your money back until the end of that term. So if you have a 6-month term, obviously you get your money back after 6 months. If you have a 60-month term, well, then you've got a good 5 years before you are going to get your money back. But again, you are locking in an interest rate with the idea that you believe that is going to give you the best return on your money, or maybe it is going to be sort of a safe source of getting income off of the money that you deposit. Now, the thing with the CD is, because you have those terms and you're sort of making a loan to the bank and you are committing to allow them to keep that money and use it in any way they want to until they return it to you, there's a penalty if you want that money early, at least in the vast majority of CDs. So what's going to happen is if you say, hey, I want my money before it is the end of the term, they are going to penalize you some amount of the interest that you earned. And depending on the length of the CD, it could be just a few months. It could be up to a full year of interest that you would lose if you decide that you want to pull that CD before it has actually gotten to the end of its term. Now, another way that CDs are different than bank accounts is that when you deposit the money, when you take out that CD to begin with, you are putting in as much money as you want to deposit, and that is it. You are not adding money to that CD on an ongoing basis when you happen to make more. So if you take out a CD for $2,000 and it has a 1-year term, that is it. You are going to have that $2,000 committed to the bank for that year. They are going to give you the $2,000 back with interest at the end of that year, and then you could take that money and do whatever you want with it. So if you take out a CD and then you get some more money and you want to put it into a CD, you would have to open a new CD. In addition, and this follows from what I just said, CDs are an all or nothing proposition. Just like you cannot add on to a CD once it has been established at a certain money level, you cannot take out part of a CD if you decide you need some money before the end of the term. So you are either going to keep that full amount in the CD for the full term and get all of the interest promised to you, or if you decide you're going to withdraw and take a penalty, you are going to take everything out at one time. Now, because CDs require you to commit your money for a certain period of time, and because you don't know what interest rates are going to look like in the future, one thing that you might consider doing is a CD ladder. And what that means is, instead of taking all of your money and deciding you are going to put it in a 3-year CD or a 5-year CD or a 1-year CD or whatever, you might choose to actually take the money you have and split it into multiple CDs that have different terms, different lengths of time before they are going to reach the end and you are going to get the money back. So you might, instead of taking one CD that is a 3-year term, you might take your money, split it up, and have one CD that's a 1-year term, one CD that's a 3-year term, one CD that is a 5-year term. And what that does is it means you're getting different interest rates on those monies to begin with, and then every time one of those CDs matures, you can reinvest it into a new CD at whatever the interest rates are at that point. And what this does is it sort of hedges your bets a little bit. It could mean that you don't get the absolute best interest rate on all your money, but it also guarantees that you're not going to get the worst interest rates on your money all the time either. So it's a way to make sure you don't lock in your money and at an interest rate that ends up being far lower than the sort of prevailing interest rates over that period of time. So you're not getting too high, you're not getting too low, you're sort of just right, or at least that's how some people would see it. Now that I've told you everything about how CDs work, I should mention that some banks are going to offer CDs that go against what I just said. They are going to allow you to put more money in, or they are going to allow you to take partial withdrawals. But in reality, those are not CDs in the traditional sense. They are sort of hybrid products that are CDs and savings accounts sort of rolled into one, and they give interest rates that are less than you are going to be able to get on CDs that require that commitment from you. So when we talk about the best rate CDs, they're not going to be any of these hybrid products. They are going to be those CDs where you have to commit your money for a certain amount of time. And if you're wondering how taxes work on a CD, the interest that you earn on CDs is treated as regular income, just like any other interest that you would earn on a bank account. So it is not that you are going to get any sort of tax advantage from a CD. You simply are trying to get more of a return on the money you invest than you would get from a standard bank account.